Hello, my name is Brian Overby, and welcome to Options Guy TV. I'm the author of The Options Playbook, and we took a little bit of a vacation on Monday. The markets were closed for Labor Day, and so we talked a little bit about uh, the Greeks, and we'll do some educational pieces whenever we have those Monday holidays. So now we're going to jump right back into it, but we've had a lot happen with the paper trades that we put on. Mainly because we had so much time between when we talked about our trade on Friday, and the most recent paper trade that we looked at was in Dollar General, and where we're at in the marketplace today. So we're going to just jump right into it, and let me pull up the Dollar General chain and inside the options grid inside the Trade Hawk software, and we'll look where the chart is at. So if we go to Dollar General, and I've zoomed in a little bit here, we put Dollar General together on Friday. In other words, I guess we set up the trade on Friday as a better way to look at it. And it had a lot to do with this little area inside the chart. The stock was at, and let me just highlight it here. The stock was at about 131 when we put that trade on, a little less, right around there, right where my crosshairs are on the screen. So we definitely had a breakdown. They announced earnings, and that was the big gap down. And that was kind of our trigger. Right in this area, there was a lot going on, especially if I zoom out on the chart, you would see there was a lot more going on in that area. We were thinking about getting long or short Dollar General around that earnings report, but we were in such an area of flux on the chart. But the momentum was definitely to the downside with Dollar General. It was a darling during the COVID times, but most recently the stock has really sold off. They had a poor earnings report, and they also came out with weaker guidance, saying the consumer is getting a little weaker on their end. And it's a little bit befuddling when you think about Dollar General and you think about worries on the economy. And Dollar General is usually where people will go if they're worried about a recession. But now we're talking about a soft landing. All this other wage growth has still been strong, even though we've got some medium numbers in the job market, something that might actually make the Fed feel pretty comfortable. And actually, to mention that, we got the Fed meeting is about 14 days away, and I just looked at the Fed funds rate, the possibility of them raising another quarter of a point, and that's dropped all the way down to under 10%. So according to the CME Fed Watch tool, or there's about only a 9% chance that the Fed is going to raise interest rates, and that has kind of fueled the market. We're in September. We got a little bit of risk going on just with the seasonality of the marketplace. And we saw the sell-off on Dollar General, and it continued, and it came all the way down, and the low here was around 125, and that's fairly important because that's actually what we targeted in our long put spread. But today we're seeing some strength, and it's a little bit odd. Once again, it's bucking the trend because the markets are actually down today, but we're seeing a little bit of strength in Dollar General. So let's go back and let's review the trade and decide what we want to do with this trade. So the expiration that we chose in Dollar General was the 15th expiration. The market was at 131.10. So let's go to the 15th. There's still 9 days remaining on that. And the market was at 131, and now it's at 130. So if I look at this trade, and let me set this up down below inside our order ticket, we have the strikes that we were using in the trade. They're highlighted, the 130 and the 125. We bought the 130. We bought the more expensive one. We sold the less expensive one. We did this entire trade for 130, $1.30. So that meant for every 1-by-1 long put spread that we put on, we paid $130 plus commission to put that trade on. We had 5 points maximum is what that spread could trade for, the difference between the strikes. And we paid 130. So if you take 5 minus 130, you have $3.70. That's the maximum upside that we see there. And if you have any questions about how we set up that trade, feel free to put them in the comment section in YouTube. We'll be happy to try to address any of those questions that you may have. So if I look at this trade, so let's see what happened. We had the market go down actually precipitously. If anything, it went down too fast. Here's the downside of doing a long put spread versus just a long put, is that when you put on a spread, you are buying an option contract that obviously wants the market to go down. You're buying that put, but you're selling an option contract that wants the market to go up. So in order for that spread to max out, you need some time decay. And in this instance, that would be on the 125 strike put. If the market went down to 125 and it was trading within that range, and I would have at least, and at that point in time, I should have more than doubled my profit on that position. We wouldn't get the maximum on the trade, but I would have more than doubled it. So we're talking about $1.30 to $1.50 in profit. I would have got out of the trade, and I would have a target set that if the stock gets to 125, I want to look at where the spread is at. I can't determine exactly where it's at. It's better if it gets to 125 later, closer to the expiration date, than sooner. And it happened sooner, but that's okay. We're not going to be upset about that. And I would have closed out that trade. But now we're actually seeing some strength. So if we look at the SPX, we're down almost 1%, around 37 points in the market. That's a fairly strong down day, but we're seeing the Dollar General is up almost 1%, up 99 cents at 128.21. So now we're in this area of limbo. If you did not get out of the trade, and it is a paper trade, so but in general, if you did not get out of the trade, then now what would you do with this market being just sitting right in the middle of your strikes? First of all, I would go and look and see what it's trading for. So right now it's trading for, and I have this in $2.17, $2.20. So if I missed that opportunity and I paid 130 for it, I'm almost up $1 on the trade. So at this point in time, I would think very hard about just closing out the trade. Now, the other alternative, and it's not that exciting of an alternative, is do you want to really get bearish? So now that we've had the breakout, we've seen the follow through on the breakout, but we do got an update today. So it's a tough one. My only other thing that I may consider doing is just buying this put back and just being long the put. If I really believe in the weakness, the seasonality of the marketplace, and believe in the weakness that I'm seeing in Dollar General, then I'd consider buying this one put back. I would have a small loss on that put and just getting long the 130 strike put. That would be the only other adjustment I would consider. So my three options right now, I should have sold. I'll say the three scenarios. When I hit 125, if I had more than doubled on my profitability on the trade, it means it would have been trading for 260 or more. I would have just gotten out of the trade. Now that it's bounced back, came down, bounced back, and we got kind of some strength into a weak marketplace, I would consider maybe selling it out right now and trying to make approximately $1. As a matter of fact, it's going up as we speak, almost an entire dollar. It's $2.28. So maybe Dollar General is listening to this podcast and they're starting to bring the market down or bringing the stock down. But with that said, I think that would be the one that I would do the most right now. I would just enter this order. How would we close it? We got buy to open. I would go on in and I would sell to close the buy to open. I'm going to hit sell to open because I don't have the position on. This is a real account or a test account at least. And then this was sell to open and this would be a buy to close. And then you see that it now changes from a net debit to a net credit to the account. And that would be my trade today, especially since, I mean, gosh, we ran up about 20 cents while we were talking. The price of the long put spread went up about 20 cents. So I'd be up almost $1 on the trade. I would get out of it right now. All right. Well, I see a question. Let me add that question here. Why did you set up this with out of the money puts? So I understand that question, because a lot of the times when I'm setting up a spread, I like to straddle the marketplace, and I make that long put spread or long call spread a situation where I'm buying almost as much time premium as I'm selling. And in order to do that, you want to go equidistant in and out of the money. If I go in the money, I obviously have intrinsic value. But if I'm equidistant, meaning that, let's say the stock is at 130 and I buy the 132 and I sell the 128, right? So in that scenario, I'm 2 points in the money and I'm 2 points out of the money on the option contracts that I'm using. Normally, the time value in both of those option contracts is going to be very close, and you take that out of the equation. So when I'm looking at more of a longer term trade, speculating around an earnings report, I have a tendency to try to take time value out of the equation. Now, the downside of that is the in the money option contract is obviously going to be expensive because it has intrinsic value. So in this scenario, we had the news from earnings. We saw the downtrend. So I didn't mind speculating a little bit by going out of the money because of the way that we're setting up the trade. We're setting up the trade because we liked something that we saw in the chart. It was going to be a short-term blip. And if we were broke up above the resistance, I guess, at that point, it was support, then it became resistance. And if we broke up above, I didn't want to have a lot of risk on the trade. So by going a little bit out of the money, I reduced the risk. We only had risked $1.30 on the trade. And it was just pure speculative trade based off of where the chart was at. So thank you for the question. Very good question overall. All right. So, well, it looks like we hit it right on the right spot. So if we did sell at 228, now the credit's only $2.05. So our timing would have been perfect to try to get out of that trade, because it's already back up. Look at that. It's up $1.24. So this market's really moving in Dollar General. Interesting. All right, let's do something else that's really moving. Let's look at the VIX index. And I'm a little confused by the VIX index too. We've had some weakness in the marketplace. It is September. When we looked at putting on this VIX trade, we had the VIX right around, I think it was around $16. And this was a paper trade from a while back before we got into September. We've had a little bit of weakness in the marketplace, but the VIX is now trading at a lower price than it was when we initially put on our paper trade back in August. And right now it's trading at 1474. It's up a little bit today. We've got the market down 1%. Well, now it's almost a full point, down 40 points. And we still see the VIX just up a little bit. So once again, I'm a little confused by that. I would expect the VIX, we still have the Fed meeting. Maybe they just feel really confident that we're not going to raise interest rates. And I guess that's being shown by, I'm going to run over to the Fed futures, the Fed watch, and just take a look at it. So 1 month ago, there was a 13% chance that they were going to raise it by a quarter. And now there's only a 9% chance that it's going to happen. So I don't know if that's enough to really matter. Before Jackson Hole, though, we were up around a 20 to 25% chance. So the marketplace does feel fairly confident based off of the economic data that the Fed is no longer the risk of the Fed raising interest rates, which I do think would be a risk in this marketplace. It is really there. So here's what I want to do. I want to go in and I want to look at that VIX trade. Let me add this to the options grid. And the trade that we had is the 9/20 expiration, which is important that we're looking at the non-weeklies. We're looking at the pure monthly expiration. And I when I initially looked at the trade, I was thinking about doing this one in September, but I really don't like the markets and the weeklies on the VIX as much. The standard monthly, and how do you tell? You see the W in front of that. The monthly just has a lot more volume, a lot more liquidity. So we ended up actually adjusting our trade, but that's neither here nor there. So we went out and we did a short put spread, which is bullish. And we bought the 14 strike and we sold the 16 strike. Now, when we put this trade on, okay, come on. There we go. Froze there for a second. When we put this trade on, we did it for a net credit of 67 cents. The VIX was around 16, and now it's at 1483. That's the actual VIX index. But we talked a lot about the fact that the futures contract is really what drives the price of this option. So the futures contract isn't down as far as the actual spot index in the VIX. So in this instance, the future is trading. So the 15 strike call is more than the put. It would be somewhere right around there. I will do ask to bid. So I'm going to do a real quick calculation to figure out where the actual index is at, plus 15. So we're at 1547 on the September contract. Now, this expires on the Wednesday that the Fed's meeting. These option contracts do. So maybe that's a little bit of a reason why it makes sense to me with the VIX down around the 14 level, and we are in September, that the futures contracts would trade at a higher level. I've already kind of mentioned the fact that I don't really understand why the VIX is where it is. There should be a little bit more nervousness in the marketplace. It doesn't seem like that. There's more complacency than nervousness. We've seen some weakness in September. I want to get long an option contract. I guess I'm trying to talk myself into it as we are on the show. We sold this. It's trading now for 27 cents. We sold it for 67 cents. So we're down 40 cents on the trade. We brought in that net credit of 67 cents, which, it's not a good scenario. And I want to spend it. So I'm going to actually add a little bit of risk to this trade. And that was my plan to start with anyways. I really wanted to get long a call option with the credit from the put. Hasn't really worked out that much. And I'm just going to double down on it and hope that we get a little bit of a reaction in the marketplace sometime soon. So here we go. It's going to be 9 days. We brought in a credit of 67 cents, even though we are down on that trade. The market right now is just below the 16 level. There is some risk that we could lose some more on that trade. I'm going to take that and buy the 17 call. That simple. So this is 100% a paper trade, not meant to be a recommendation. I want to do this because I'm annoyed that the VIX is at 14. I'm not really happy about that. So I'm going to buy the 17 strike call, and this is going to be my entire position. I'm going to take the credit from the initial trade. I don't want to spend more than that credit, and I'm going to buy this 17 strike call. It's within a 1 standard deviation. Well, it's not quite, because the numbers are going to be a little bit off because of the futures thing. But it's relative that the underlying could get to that 17 level by that expiration date. Now, I'm not going to mess around with this a lot. If we get the big spike up and we do see the futures contract actually, let's say, go towards the 17, 18, or 19 range, I'm going to want to get out on the trade, and I just don't want to mess around too much with this, mainly because we do have the risk on the downside of the short put spread in general. All right, so if there are any other questions, please feel free to put them in the comment box or in the chat box on YouTube, and I'll be happy to address them. If not, well, the Dollar General trade turned out just fine. It did what we were expecting. We bought an out of the money put spread, and that's a little bit more of a speculative trade to me than an in the money put spread, where the put that we're buying has some intrinsic value. And we took this VIX trade and adjusted it. It's not going against us, but we should be right, not the market, right? I don't know why we're trading where we are on the VIX. So we're going to actually get long a long call, and it's just going to be a little fun trade to watch going into the Fed meeting here in 14 days away. And I don't see any other questions, so that's going to be it for this edition of Options Guy TV. We will be back this Friday at 11 a.m. Eastern time. We'll look at these two trades and have a new trade for you going into the weekend. Please click subscribe, ring the bell, and pound that thumbs up. And we'll see you this Friday on the next edition of Options Guy TV. Thanks for coming, everyone.